Hi, dreamers. Okay, let's jump right into it. I'm going to take a look at the dizzying commentary on both JEPI and JEPQ and give you my take, and show you guys what I'm doing in my portfolio. But to start, I asked you which one you liked, and it was a landslide for JEPI. Wow, guys. Okay, you ready for my take? Here we go. So if you've been doing research on JEPI and JEPQ, you've probably noticed just a lot of noise out there. And I'm going to show you some of that noise. So right now I'm in Seeking Alpha, and you can see this article says JEPI, stellar dividends in volatile market conditions. Fantastic! But wait a minute, now this one says JEPI got left behind by the market recovery. That does not sound good. And then you go over to JEPQ, a quality high-yield ETF with prospects for notable upside. Sounds fantastic. But wait a minute, outperformance likely, but positive returns will be difficult? I'm confused. And then there's a ton of these kinds of articles. JEPI versus JEPQ. Which one do you like? And I swear, I've seen them all over the map. And it really leaves you thinking, what in the world should I be doing here? And many folks just decide, well, JEPI's been out longer. There's a lot more people that I know doing JEPI. So I'm going to go there first. So let's dig in a little bit and then I'll show you what I've done. So in this article, it's basically making the case that there's going to be a lot of volatility in the banking crisis, the interest rate hikes, the oil cuts, and why not just rely on this high yield in this uncertain macroeconomic environment? Well, that makes a lot of sense. So one thing that I thought was interesting in this article was at the very bottom, where it starts to talk about JEPI's dividend guidance in a normalized environment, given that we haven't been in a normal environment. It's been very volatile. And here it talks about how, while JEPI may have been delivering stellar dividends just thus far, that going forward in a less volatile sideways market and potentially a bull market, that based on management commentary, the ETF is only designed to deliver between 6 and 10%. So that's kind of interesting because if you factor in the tax rate, you may be getting less of an annual dividend yield than you thought you were, about 5 to 8%. Now let's look at this article written in February, which I tended to agree with. It first does a nice job of just talking about the fact that at just 7 months old, the ETF had already gone down about 16%, and that he was noticing a bit of a multiple bottom pattern. Now, just to review, JEPQ is designed to provide current income while maintaining prospects for capital appreciation. And they do that through a combination of selling options and writing equity-linked notes. And you can see a visual representation of that here off of the JP Morgan website, using data science processing, 1 month out-of-the-money call options, designed to generate income and give investors a portion of the upside with reduced volatility. And all of that is written against the NASDAQ 100. So JEPQ is basically the same investment strategy as JEPI, it's just primarily invested in the NASDAQ. Now, you may be wondering what equity-linked notes are. And here's a bit of an explanation. It's a way for investors to protect their capital, while also getting the potential for above-average return compared to regular bonds. And in theory, the upside potential for returns in an equity-linked note is unlimited, whereas the downside risk is capped, such that in a worst-case scenario, most equity-linked notes offer full principal protection. So in a way, this is an advanced strategy that would take some skill and knowledge to execute for the average investor. And if you watched my tax video, you already know this, but it's stated again here that JEPQ and JEPI really are best held in a tax-advantaged account, because most of the income is actually coming from those call options and equity-linked notes that will be taxed at an ordinary income level. And so you can see the top 10 holdings for JEPQ: Microsoft, Apple, Google, Amazon, Nvidia, Tesla, and Meta. And if you're at all familiar with writing calls, these stock picks generate nice premiums. You can also see the sector exposure here with communication services, consumer discretionary, and then this infotech at 42%. So it's heavily weighted there. Now, he goes on to say that he believes that 2023 is going to be a completely different story than 2022 and should bode well for tech stocks. And that's something that I'm going to show you in a minute that I agree with. And that fact alone has really driven my decision on what I've done. So for now, put that in your hat. It'll come back later. So he ends the article by saying that he thinks that JEPQ and JEPI are both great additions in terms of a quality high-yield income portfolio, but that he believes that the Fed is very close to pausing its rate hikes, which should be a major tailwind for the assets held in JEPQ, and that his 12-month price target is $50, which would imply a 17% upside potential. Now let's go to another article reviewing JEPI and JEPQ, which is fairly recent, March 28th. So in this article comparing JEPQ and JEPI, the article writer starts by pointing out a comparison between JEPI and NUSI, which from July 2020 to January 2023, they point out that JEPI's total return was way better than NUSI, which was based on the NASDAQ 100. Now, I just want to point out here that this is a common analysis looking backwards and making decisions based on what has already happened versus what we think is going to happen. And that's something for you to be thinking about always, is looking in the rearview mirror for context, but then immediately looking out your windshield to think about what is going to happen. Because that second part is going to be the most important part when you're making decisions on what to do next. And so in this article, he continues and compares from May 2022, when JEPQ was introduced, with the same time frame for JEPI, and basically is showing here that JEPQ did not do as well as JEPI for total return. And so his verdict was that NUSI never won against JEPI. And in the current case, both JEPI and JEPQ employ similar but not identical option strategies, and that they believe over the next 5 years, SPY will do much better than QQQ, and points out that JEPI has 11% in the infotech area, and actually has more in the financials and healthcare, and that JEPI sells calls on the S&P 500, maintaining a value bent. In other words, selling calls on a different set of holdings. And so their determination is that JEPI wins. And so at this point, guys, I hope that I've royally confused you because that's the state that most people are in when it comes to JEPI or JEPQ. So let me show you my thoughts. First of all, this is me in Seeking Alpha creating my own chart where I have year to date what has occurred. We've got JEPI at 2.46 total return year to date. We've got SCHD at a negative 1.17%. And we've got JEPQ at 14.13%. Now, how could that be? Does that surprise you in terms of the total return this year? Now, I go into my TD Ameritrade, and sure enough, you can see the year-to-date return for JEPI being under 2%. Whereas, when I go to JEPQ, there's that much, much higher year-to-date market return. I also think it's interesting when you go to Fidelity and you scroll down to the analyst ratings on something like JEPI, and you see efficiency, tradability, and fit 89, 99, 49, where efficiency is measuring how well a fund delivers on its core promises to investors in things like expenses, risks, tax exposures, etc. And then you go to JEPQ, 91, 99, and 66. I also wanted to point out this little bounce that started happening mid-March, and you can see the incline here. And the same kind of thing has happened with JEPI as well, but you can see the lift and the rise is not quite as sharp as it is with JEPQ. And I also wanted to just point out the top holdings inside of JEPI: AbbVie, Progressive, Hershey, Pepsi, MasterCard, Microsoft, Coca-Cola, Visa, Texas Instruments, etc. And so the question becomes, these holdings start to rebound and provide options income over the coming year, as opposed to Microsoft, Apple, Google, Amazon, Nvidia, Meta, and Tesla. So I'll cut to the chase, guys, and tell you what my opinion is and what I've done. And I'll talk to you about that while we're looking inside of one of my accounts. So here you can see I've purchased JEPI, and this is actually the only place that I held it. So I've got about $50,000 in JEPQ and only about $9,000 in JEPI. So I guess that means I'm preferring JEPQ about 5 to 1. And my reasoning is the following. First of all, I just started buying both of these. And key in my poll was when I asked if you were to start buying these right now, what would you start buying? So I started buying both in around February, right before those bounces started. And I'm not reinvesting in either one. I'm using the cash flow to reinvest in other equities. And so you can see ever since I bought JEPI, it's been almost flat with only a 0.45% gain. Whereas for JEPQ, I've actually gained over 4.5%. And I do believe that we are going to have a tailwind on tech over the next couple of years, driven by a pause on federal rates. I also believe that we've bottomed a bit on tech. And so I believe there will be a rise or a little bit of volatility in tech over the next couple of years. I also think that JEPI could slow down in terms of the dividend payout. And so that's something I'm watching for. And I also believe that there is some upside potential of maybe 15 to 20% in JEPQ. And in my mind, both of these are unproven strategies that I'm just keeping an eye on. And as you know, in my other video where I talked about high yield additions to my portfolio, I'm looking at this as just a cash layer on top of my rock solid individual dividend stocks that really power my income and my growth every single year. So I would never have something like a JEPI or a JEPQ be a substantial part of my portfolio overall. So my plan is to hold these for now in the next 2 to 3 years. Well, that's it for today. And if you're interested in a premium Seeking Alpha subscription to do additional research, please feel free to click on the link in the description. As you know, I'm an affiliate. And don't forget to also follow me on Instagram and Twitter if you'd like more of a real-time daily interaction. Okay, as always, I encourage you to do your own research, then implement and learn by putting it into practice. As a reminder, I am not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.